What's going on, Eagle investors? This is Samuel here to talk about risk management and sizing, particularly as it relates to an active options portfolio. Now, to start off, risk management starts with setting up a position properly and sticking with a plan. Now, it's critical to understand the risks associated with each position as well as the portfolio. Now, sizing trades appropriately is needed for account longevity while also minimizing risk without sacrificing returns. Now, to start, you have to have a plan. So, to do this, you have to know your thesis, know if it fits your strategy, and then define your terms. Now, what do I mean by having a thesis? Now, before you enter a trade, whether it's a long call option or short stock or a short iron condor or whatever it may be, you should have a thesis for that particular move. Now, for example, if you have some fundamental views on an undervalued security and believe that its long term prospects are extremely favorable as it relates to the industry and the market as a whole, taking a long term stock position would make sense and be favorable. And then that strategy would fit your thesis. Now, however, if you have a very bearish opinion on a stock as it relates to short-term movements, and you believe that the volatility is also under accounted for, and the expected move is smaller than you believe the underlying can go, a put option might be, you know, a fitting strategy for your thesis. Now, what do I mean by does it fit your strategy? Now, if you believe Apple is going to go up in 10 years, you shouldn't buy a far out of the money call option that expires next week. Sure, they are both bullish Apple positions, but your strategy isn't fitting your thesis. So that's what I mean by that. Now, defining your terms, and you have to do this, before you enter the position, because that's when you are less likely to be influenced by emotion or fear or greed in the market. So either set proper stop losses, some type of time frame, or specific catalysts that you could point to that would determine an exit or a entry. Now, what I mean by this is some people go by levels, some people go by, breaks and technical levels. Some others could go by fundamentals in the marketplace that one could determine. Now, my only precaution there would be make sure that it's something that's quantifiable or objective, or else your more fundamental approach could be more ambiguous in nature and leave you either bag holding or greedy with an individual position with no defined exit plan. Now, with technical levels, it's a little more black and white, whether it's crossing the 50-day moving average or breaking, so-and-so support or finding this resistance. That's more easily findable. And then you just have to make sure you stick with your plan once there. To do that, you have to make sure that you pay attention. Now, pay attention not just to the terms that you defined, and your time frame, the stop loss, the overall health of the position, but also follow the price moves and the relevant news that could impact your position. Now, it might not be, terribly important if you're day trading an individual stock and some industry news comes out that is only unfavorable for the underlying, far down the line. However, depending on how you're trading and what strategy you're using, there can be very relevant news that you should be aware of. Now, you should also understand market risk. Now, unless you're using some type of neutral strategy, or if your whole portfolio is delta neutral, as we talk about in hedging options and understanding the option Greeks, you should understand that there's likely market risk within the underlying security that you may be trading. Now, you also want to evaluate risk to reward. And what I mean by that is let's say you're bullish on Apple, and you think there's a 50-50 chance, that it goes up from here. You likely shouldn't be buying some far out of the money call option on them that's expiring in short succession. Now, if your level of certainty is greater, and you're extremely bullish, then you could see, if this thesis plays out, I stand to win 300%, and the most I can lose with this strategy is 100%. That's a positive risk reward. Or on the other side, if you're more bullish to neutral and you implement, let's say a credit put spread strategy, you might have, 80 or 90% certainty on, that underlying staying above your short option strike. And, if you're able to capture, premium of 20 or 30%, that could be a very favorable risk to reward position, even though the amount you're risking is greater than the reward. So you have to factor in the probability of that event happening. Now, next, you have to know when to exit. And again, you're most objective about a position before you enter it. That goes a little more into psychology of trading, but that's when you want to set up those frames, be it on the positive end or the negative end, whether the position goes for you or against you beforehand. Know when to exit, and exit when that is indicated. Now, next, some general tips would be, in general, you don't want to add to losing positions. This is often done out of fear of loss, and just trying to double down. And this works in theory, always being able to double down until it wins, but that's also a fallacy, and doesn't work out, as you don't have an infinite bankroll, and probabilities can really add up and turn against you, even if it's less likely to occur. So this can increase and lead to increased losses with a failed market thesis, and also lead to overexposure to even just the probability distribution. And you might experience, a three sigma event, or a chain of trades that go against you. And even if you generally don't overexpose, and your thesis was spot on and great, just because of the way that the events shook out, and the fact that you doubled down and did lead to that overexposure, you could find yourself in your portfolio heavily down. Next, you'd want to make sure you isolate upward volatility. Now, what that means, and a few ways to do that, are identifying positive risk reward positions while focusing on greater returns than the risks at stake. One way to do this is by letting your winners run, and by cutting your losers early. And what this would mean is, sure, you might have a mix of winners and losers, and you're always going to have a mix of winners and losers. But if you're able to identify the losers early and cut them with minimal loss, then you can focus on the few winners and the trades that you have that go for you, and let those increase and appreciate on a much more magnified level that more than accounts for the losses. Now, this means that your portfolio might be volatile, but only on the upward side. Now, next up, where to set stops. Now, it's important to set stops on all of your positions. And we talked about it fitting your thesis, whether it be price level or some type of fundamental catalyst, or anything of that nature. It's important to have them and to place them while you set your thesis, before you're more likely to be influenced by the actual moves of the market. So you want to identify where your thesis is disproven. For example, if you take a standard technical thesis and setup, if an underlying very recently breaks a resistance level, it's likely to, or the thesis would be that it's going to run and continue its upward momentum to the next resistance point. Now, where should you set your stop loss then? Well, your thesis is disproven if it breaks that resistance, and then a day later falls back down and closes below that same level that was your entry indicator. Now, some would would want to hold that position and see that they want to stay in it because it might go back up and they still like the position, it still looks good. But if you stick to your objective thesis, that breakout that you identified and the potential for it to continue its upward momentum to the next point did not occur. So you should exit immediately and cut that loss early. Now, next up, you want to keep this metric and keep this point for any position you have and make sure that it fits for whatever strategy you might be implementing. Now, sizing for success is also very critical. We touched on, the idea of probabilities going against you. And what we have here is, a normal distribution. And it's critical to understand you're going to experience losses and you're going to experience wins, but you can't determine or say when your losses are going to happen. So if you put 100% of your portfolio in every trade, obviously you're going to experience some losses and your portfolio is going to completely go bankrupt. Now, if you size much smaller and let's say you put 1% of your portfolio in every trade, now the success rate and the success and the average return you're going to experience will be a lot more true to the theoretical probability of the strategy you're implementing, as the tail risk is drastically minimized. And that also minimizes the volatility and the drawdowns that you will experience. So it's important, the importance of multiple trades. Like I said, there's always winners and losers, and losing trades are unpredictable. So you want to maximize your sample size. Now, how to do this? Trade small, trade often. So you don't want to go all in, and you want to stick to sizing guidelines. It's generally recommended to keep your positions under 5% of your portfolio. And for even larger portfolios, if you just do 2 or 3%, that's also very good. Now, what this also does is it minimizes drawdowns. And this is important if you understand a little bit of math, right? So think about it like this. If your portfolio goes down 10%, for it to be break even again, you have to go up not 10%, because that would make you go from 100, 90, 10% more would make you go to 99, not 100. You have to go up 11% to get back to 100. Now, okay, that's the difference in one, going down 10%, up 11%. Now, if you have a much more volatile portfolio because you're sizing much larger and your portfolio, instead of going down 10%, goes down 50%, you don't have to just go up 50% or 51%. You have to go up 100% to get back to break even. You can imagine this is difficult and more difficult to recover from. So minimizing your portfolio drawdowns not only minimizes your risk and is more favorable in general to have a less volatile portfolio, but it makes it more likely to stick around, as well as more likely to be able to recover from any loss experienced. Now, this also allows you to reach true probability. Now, limiting trades increases uncertainty, but the law of large numbers states that the more and more occurrences that you experience, the closer you're going to reach toward that true probability. And this is a great way to combat random market events and outlier moves in the marketplace or in underlying securities that might be drastic to an individual with improper sizing guidelines. But for you who only puts in 1, 2, 3% of their portfolio in a trade, even if you see a few of these outlier moves in the marketplace and against your positions, it won't be the end of your portfolio. Now, diversifying is also very important and is one other way that you can experience the same, if not greater, returns with no additional risk. Typically, in the investment and trading sphere, it's commonly said, more risk or more return, you need to take more risk, vice versa. If you want less risk, you have to accept less return. Right now, compare high beta stocks that are very volatile, average return, to a 30-year bond with a lot less uncertainty but a lower return on average. Now, there's a caveat here. There are ways to maximize your return that actually do not impact your risk. For example, by trading 1,000 positions instead of 2 positions, like we touched on with the sizing guidelines, you're not actually risking more. You're actually risking far less because of the law of large numbers and the outlier risk and all of that. But your returns are theoretically the same. The probability that this strategy yields X% is the same whether you do it twice or you do it 1,000 times. So that's one way to maximize those returns and minimize the risk. Another way is diversifying. And I don't just mean diversifying with different underlyings, but having your trading activity leading to true probability, but adding uncorrelated trades to increase the risk adjusted returns. Now, what I mean by that is, if you're only trading tech stocks, it doesn't matter if you have 100 different positions open. If they all have a high correlation, you still essentially just have one position, and it's still highly risky. But if you're long stocks, you're short stocks, you're in various option positions, commodities, currencies, you're in all these different or less correlated positions, your returns won't be impacted from, again, the X amount of return that the strategy implemented should yield, but your risk is drastically reduced. So diversifying underlyings, strategies, making sure to also diversify the Greeks. And if you haven't already, make sure to check out the hedging options where we dive into the major 4 option Greeks: delta, theta, gamma, and vega. Now, to summarize, managing risk positions traders for capital preservation and more stable returns. Now, this doesn't sacrifice returns either, but it does mitigate risk and downside volatility in a portfolio. So trading small often leads to more statistical returns and minimizes drawdowns. And as famous hedge fund manager Ray Dalio stated, uncorrelated assets are the holy grail of investing. So identifying uncorrelated positions and how putting those into a portfolio will allow you to drastically reduce the risks, the overall risk of your portfolio, not looking at an individual position, but your portfolio as a whole without sacrificing return. I hope you enjoyed this video. Thank you very much.